Hello everyone, in this module we study Chapter 2, Financial Markets and Interest Rates. The learning objectives include operations of U.S. financial system, financial securities, function of financial intermediaries, financial markets, and securities traded in the money and capital markets. The financial system. The purpose of the financial system is to bring together individuals, businesses, and government entities, also economic units that generate and spend funds. Surplus economic units have funds left over after spending all they wish to spend. Deficit economic units need to acquire additional funds to sustain their operations. According to the characteristic of participants and the securities involved, the primary market is where deficit economic units sell new securities. The secondary market is where investors trade previously issued securities with each other. Money market trade short-term, 1 year or less debt instrument, for example T-bills, commercial paper. Major money center in Tokyo, London, and New York. Capital market trades long-term securities such as bonds and stocks. New York Stock Exchange, American Stock Exchange, over-the-counter market such as NASDAQ and other OTC market. Intermediaries such as commercial banks and insurance companies help to facilitate the flow of funds in the financial markets. Market efficiency. Market efficiency refers to the ease, speed, and cost of trading securities. The market for the securities of large companies is generally efficient. Trades can be executed in a matter of seconds and commissions are very low. Money market securities include a high liquid and low risk financial instrument such as treasury bills or T-bills, certificates of deposit, also called CDs, commercial paper, euro dollar, and a banker's acceptance. Capital market securities include bonds or IOUs issued by the borrowers and sold to investors. The issuer promises to repay the face amount on the maturity date and to pay interest each year in the amount of the coupon rate times the face value. Bonds include treasury bonds issued by the federal government, municipal bonds issued by state and local governments, and corporate bonds issued by corporations. Stocks. Common stockholders own a portion of the company and can vote on major decisions. They receive a return on their investment in the form of dividends and capital gains. Preferred stockholders do not generally have voting rights but have priority in receiving dividends and are paid dividends at a preset rate. Interest rates. Interest rates determined by real rate of interest, expect inflation, default risk, maturity risk, illiquidity risk. Determinants of interest rates. The nominal interest rate is observed rate on securities. It equals to real rate of interest plus inflation risk premium plus default risk premium plus maturity risk premium and plus a liquidity risk premium. Term structure describes the relationship between long and short-term interest rates. It is also called a yield curve. The yield curve could be upward sloping or downward sloping or be flat. So normally the upward sloping is called a normal yield curve. The downward sloping is called abnormal yield curve or inverted yield curve.